Good evening to all. On behalf of Andhra Chamber of Commerce, I welcome you all to this webinar on analysis of Union Budget 2022-23. It's actually a customary that every time, whenever immediately after the budget is organized, we are the first chamber to organize, but this time we are the second. I think yesterday Tamil Chamber has organized. So today we are doing this program for the benefit of our members. And just to introduce about the chamber for the people who have joined us new. This is one of the oldest chambers in South India, Andhra Chamber of Commerce. And this has been spread across in 3 states, that is Tamil Nadu, Andhra, and Telangana. We have around 1,300 members. We have branches in Vizag, Vijayawada, and Hyderabad. And first thing that I would like to inform that our president could not join today because of her bad throat. So I request the chamber has got around 16 subcommittees, vibrant subcommittees on various trades like foreign trade, indirect taxes, direct taxes, export, import, MSME, like that. And we have with us an eminent person, Mr. V. Sampath Kumar, the Chartered Accountant and Chairman of Indirect Tax Subcommittee, and Mr. I think Mr. Siva Prasad has also joined. He is the Chairman of Direct Taxes Subcommittee. With this few words, I request Mr. V. Sampath Kumar, the Chairman of Indirect Taxes Subcommittee, to please give the opening remarks.
Esteemed speakers of the day and Subcommittee Chairman for Direct Taxes, Mr. Shiva Prasad Garu, Executive Committee members of the Chamber, ladies and gentlemen. It's a great honor for me, the responsibility bestowed on me today to initiate the welcome address for and on behalf of the Chamber. I deem it a pleasure to extend a hearty welcome to this webinar on the analysis of Union Budget 22-23 organized by Andhra Chamber of Commerce for the benefit of our members, invitees, and guests. I extend a warm welcome to Shri M.R. Venkatesh, Chartered Accountant and Advocate, who is going to join shortly. We will be addressing on the economic overview of the central budget. I also extend a hearty welcome to Shri Banusekar, Chartered Accountant, and Shri R. Subramanian, Chartered Accountant, will be addressing on the direct and indirect tax implications of the budget, respectively. Our Finance Minister, Srimati Nirmala Sitharaman, has to be congratulated for the presentation of the Union Budget to take India to India 100. Glad that when the proposals implemented be it for a digital economy, health infra, or creation of 60 lakhs new jobs, etc., the growth of our great country will grow into a global leader in the days or years to come. And the vision with which each segment of the economy was looked into is also commendable. There are various aspects like this. To give more time for our friends to deliberate, I stop at this point, and we have with us the great speakers. And with all this, I once again welcome each of the person who have joined in this room and my esteemed speakers. Thank you, Madam.
Thank you, sir. Before we go on with the first session, I would like to introduce the speaker, Mr. Banusekar. Mr. Banusekar is in practice as a partner in Messrs. CRBS and Associates LLP Chartered Accountants since 1994. He has contributed articles on direct taxes and indirect international taxation to several tax journals, including Consolidated Commercial Digest, published by the publishers of Income Tax Reports, Taxman, Tax Referencer, and the Income Tax Review, published by the Chamber of Tax Consultants, Mumbai. He has argued in a number of landmark cases before various benches of the Income Tax Appellate Tribunal across the country, which have resulted in establishing precedents for many common contemporary issues. Mr. Banusekar has authored the following books, that is Handbook on the Assessment Procedure under Income Tax Act 1961, Search Assessment under the Income Tax Act. He was formerly a visiting faculty at the Institute of Chartered Accountants of India Institute of Company Secretaries of India, and the Loyola Institute of Business Administration on direct taxes. He has delivered lectures and presented papers on direct taxes and international taxation at seminars, meetings, workshops, and conferences arranged by the ICAI. He has actively participated as a trustee in BRAINS trust sessions organized by branches of the Institute of Chartered Accountants of India. He was a special invitee in the Direct Tax Committee of the ICAI and in the Continuing Professional Education Committee of the ICAI. He was the past chairman of the Fiscal Law Committee of the Southern India Regional Council of the Institute of Chartered Accountants of India. He was a former member of the Southern India Regional Council of the Institute of Chartered Accountants of India for the period 2001 to 2004. He is presently a co-opted member of the Direct Tax and International Tax Committee of the SIRC of ICAI. We welcome you, sir, and I will request you to please present on the direct tax proposals.
Thank you, madam. Thank you, Mr. Sampath. First of all, my thanks to the office bearers of the Andhra Chamber of Commerce for giving me an opportunity to share my thoughts on the direct tax proposals of the Union Budget 2022. In fact, this is not the first time I'm speaking at the Andhra Chamber. I've come here many times and I've always enjoyed, but this time the only difference is that I'm doing it virtually rather than do it physically, which is what you've been used to. Well, thank you once again for the opportunity. Chamber where I have been very frequent, which has been close to my heart, where I know quite a few members of the chamber as well. Well, friends, as far as the direct tax proposals are concerned, I'll start straight away without much ado because we have limited time at our disposal. So basically, if you look at from the direct tax perspective, insofar as individual taxation is concerned, there is hardly any change. In fact, the finance minister, while presenting the union budget itself, referred to capping the surcharge on capital gains at 15%. Now, basically, one thing that we need to bear in mind is that the surcharge on normal total income varies from 10% to 37%. That is up to 1 crore, it is 10%. Beyond 1 crore, up to 2 crore, it is 15%. Beyond 2 crore and up to 5 crore, it is 25%. And beyond 5 crore, beyond 10 crore, the surcharge is 37%. Now, one thing that we need to remember is, just for an example, if the total income of a person, including capital gain, is say 5.5 crore, total income including capital gain is 5.5 crore, then under the law as it stands presently, the surcharge will be at 25% on the whole of the tax on 5.5 crore. Now, after this amendment, what will happen is that on the capital gain, the tax on capital gain, assuming the capital gain out of this 5.5 crore is 1 crore, then on this 1 crore, the tax on this 1 crore, the surcharge will be capped at 15%, whereas on the tax on 4.5 crore, the surcharge will continue at 25%. So your slab of surcharge doesn't get reduced on the other income. This is one aspect that one may bear in mind. Now, this is probably the only major amendment insofar as individual taxation is concerned. There are, of course, a couple of amendments in relation to a charitable trust. I will quickly touch on that because that may, directly affect many charitable trusts and institutions. There are basically three major changes in relation to charitable trusts and institutions. One, wherever there is a violation of the provisions of 13(1)(c), where payments are made to persons specified in 13(3), they are proposing a penalty. Now, presently, we will remember that if there is a violation of the provisions of 13(1)(c), because of a benefit being derived by a person stipulated or a person stated in 13(3), there would be a loss of exemption under section 11. Now, in addition to that loss of exemption, there will also be a penalty. And this penalty is graded in the sense that for the first violation, the penalty is 100%. In next violation, subsequent years, if there continues to be a violation, the penalty would be 200% of such violation. This is one major change which they are proposing. Please remember that this will be in addition to the fact that the trust will lose the exemption. 2, presently, you will understand that there is a mechanism by which one can accumulate income for a period of up to 5 years for a specific purpose. So if one were to accumulate it for, say, a period of 5 years, and if for some reason the trust is not able to use the income within the 5-year period, then the law provides that it will become the deemed income of the 6th year. When it becomes the deemed income of the 6th year, it becomes obvious that in that year also it is possible to apply the income and claim the exemption. But now they are deeming it to become the income of the 5th year. So already you are violated by making it the deemed income of the 5th year. One will understand that the benefit of getting the exemption in respect of such accumulation is lost. The third is that in case where a trust loses exemption, they are making an express provision as to how the income from the trust should be computed. They are making specific provisions to say that whatever income is spent, whatever expenditure is incurred out of corpus or out of expenditure which is incurred out of loans or borrowings, etc., will not be allowed as deduction. So there is going to be a specific mechanism. Likewise, depreciation on assets which have already been claimed as application will not be allowed as deduction. And likewise, you will also see that if the expenditure has been not in the form of any contribution, or if the expenditure is in the form of contribution or donation, that will also not be allowed as deduction. So we have express provisions now as to how to compute the income in case the trust is going to lose the exemption. They also make it clear the provision of 40A, 40A3, etc. will apply in relation to determination of the income of a trust or institution. These are the major changes proposed in respect of a charitable trust or charitable or religious trust or institution. Now coming to some of the aspects relating to corporate taxation, the first major change is with regard to 14A. Now first thing, before we start on 14A, we should remember that section 14A earlier was far more widely reaching than it presently is. The reason being that 14A provides that if there is an expenditure incurred to earn an exempt income, then such expenditure will not be allowed. And for this purpose, they had a computation mechanism for the disallowance, which is provided for in Rule 8D of the income tax rules. Which is provided for in Rule 8D of the income tax rules. Now, what the courts had done was to say that if there is a particular investment which did not yield an exempt income, if it did not yield an exempt income, the fact that it is capable of yielding an exempt income will not mean that a disallowance can be made. We had decisions of the Madras High Court, we had decision of the Supreme Court in State Bank of Patiala, where they said if there is no exempt income, no disallowance can be made under section 14A. Now they are seeking to amend this by providing that even if there is no exempt income, if the investment is made in an asset which is likely to yield exempt income, the disallowance will apply. I think this is a little unfair, but all these say this is how the provisions are. But interestingly, this amendment comes only with effect from assessment year 22-23, and to that extent will not apply up to assessment year 21-22. Be that as it may, we also will recall that dividends is now taxable in the hands of the shareholder. So 14A will have no application in case where investment is made in shares. Coming to the next major change, it is in the context of section 37, where there are two major amendments that are contemplated. One, you will see that under the law as it stands presently, section 37(1) specifically provides that if there is an expenditure incurred for a purpose which is an offense or which is otherwise prohibited by law, will not be allowed as a deduction. An expenditure which is incurred for a purpose which is an offense or which is otherwise prohibited by law will not be allowed as a deduction. Now they are seeking to amend this to say that it is not only the law which is in force in India, but also a law which is applicable outside India. If an expenditure is incurred or for a purpose which is an offense outside of India, for a law outside of India, still the disallowance will operate. I don't know how this can be made operable in the sense that how is an assessing officer going to determine whether I have committed an offense of any law outside India? Can an officer interpret a law outside India and come to a conclusion that I have violated that law is going to be a major question. Of course, there is another major amendment, but this was largely intended to target the pharma companies. All of us will recall that there has been a long-standing litigation in the context of pharma companies where pharma companies were giving freebies and other benefits to directors. The Medical Council of India issued guidelines saying doctors should not accept such benefits. However, the pharma companies were continuing to give. The board issued a circular, the CBDT issued a circular stating that it should not be allowed. Despite that, various tribunals and courts have been taking a view that it is to be allowed. Reason being that the Medical Council of India's guidelines only prohibit a doctor from accepting, does not prohibit a pharma company from giving. Therefore, since the Medical Council of India's guidelines don't bind doctors, pharma companies were continuing to take that view and successfully before the tribunals and the court. Now we are seeking to amend this by saying that if a person is given a benefit or perquisite in violation of any law or rule or regulation or guideline, as the case may be for the time being enforced, governing the conduct of such person, then the disallowance will operate. So we now have the aspect relating to pharma companies also sought to be brought within the ambit of this amendment, where a disallowance can operate. However, one may notice that they have extended so far to say law or rule or regulation or guideline, as the case may be, for the time being in force governing the conduct of the person. Which means that if I am a private company and if I am going to get a purchase order from another private company and I give some incentive or benefit to the purchase manager of that private company, though it is not prohibited under any law, though there is no regulation governing it, since the guidelines of that other company of which the purchase manager works is governed by the guidelines of that company, where if it says he should not accept a benefit or perquisite from any person, then also the disallowance can operate. So the officer must now look into guidelines governing that employee, even if it is a private employee. So that is probably unintended, but that's what can happen. This amendment will again with effect from 22-23 up to assessment year 21-22. It would still be good defense to say that so far as pharma companies is concerned, see, the MCA guidelines will not operate. The MCA guidelines will not operate to make a disallowance in the case of pharma companies where benefits are given to doctors, etc. Section 40 is sought to be amended where they say education cess will not be allowed as a deduction. There are two decisions, one of the Bombay High Court and one of the Rajasthan High Court, where the High Courts held that education cess, will be allowable as a deduction. Now we are seeking to amend this provision. To say that the amendment will provide that education cess will not be allowed as a deduction. Interestingly, this amendment is made retrospectively with effect from assessment year 2005-06. This is the time from which education cess came into force. Now, interestingly, I was reading an article today where some top income tax authorities at the board level or whatever, the secretary level, have clarified that there is a difference between the old amendment in section 9, which came after the decision of Supreme Court. That was retrospective in operation. That is why we objected to it. But this amendment is not retrospective, it is clarificatory. Both are clarificatory only. Both are retrospective only. Whatever name you may give it, a rose by any other name would smell as sweet. It is retrospective only. It is applicable from assessment year 2005-06. So I would think that one should not get carried away by the new language where they say it is not retrospective but clarificatory. It is clearly retrospective in operation. Next, we have the provision in section 43D to say that interest on loan converted into another loan or debenture will not be allowed as a reduction. Of course, one may see that though there is an amendment, this again is to get over the decision of Supreme Court in Gujarat Cipromat. And this amendment is applicable from assessment year 23-24. It is applicable from assessment year 23-24. So up to that year, that problem will not be there based on the decision of Supreme Court in Gujarat Cipromat. But one may notice that the amendment is that when an interest on loan is converted into a loan or a debenture, then it will not be treated as paid, and therefore, by virtue of 43B, will not be deemed to be allowed. But when the loan or debenture is repaid or redeemed, one can definitely take a stand that now the interest is paid, actually paid, and that therefore the disallowance should be made by virtue of the provisions of 43B. The next amendment I will deal with is in section 68 of the Act. Now, section 68, I would say, is a very, very far-reaching amendment. It can affect almost every assessee carrying on a business. In fact, section 68 does not apply only to a business class assessee, but normally would apply only in case where assessees are carrying on business. Section 68 provides that if any sum is found credited in the books, then such sum, if is not true to the satisfaction of the assessing officer, will be deemed as the income of the person in whose books it is recorded. Now, courts have said that 3 criteria need to be proved or demonstrated to prove that the provisions or rigors of section 68 will not be applicable. Namely, the identity of the creditor, the genuineness of the transaction, and the creditworthiness of such creditor. 3 aspects: identity of the creditor, genuineness of the transaction, and creditworthiness of the creditor. 3 aspects. Now, what the provisions of section 68 are sought to be amended as is to say that it is not sufficient for you to prove the creditworthiness of the creditor, but if the creditor is giving it not from out of his own sources, you must prove the creditworthiness of such person from whom he is getting the money. So, in other words, what we are trying to say is, it is not enough if you prove the source. What you must prove is the source of such source also. Now, this becomes very difficult. Now, let's assume I want to borrow some money from Mr. Sampath, and Mr. Sampath has borrowed from Shiva Prasad, and then I will have to not get a confirmation from Sampath that he gave me the money and he has the resources. But I have to ensure that Mr. Shiva Prasad has resources. How far can I go? How far can I reach? It becomes almost impossible to prove source of source. And please understand that I am a borrower. I don't have money. I am coming to somebody with a begging bowl saying, please give me money. Now I must not only beg with you to give me the money, I must ensure that you have the source, your lender has the source, everybody in this country has a source, so that I am able to prove that addition should not be made in my hands. Otherwise, I may have to pay tax on such. The next amendment which I will deal with is not on 68. It is provided for in the later provisions, but something very similar to what is there in section 68. Where they say that if undisclosed income is found as a result of search or requisition or survey, if undisclosed income is found as a result of search or requisition or survey, then such undisclosed income will be hit by the rigors by which there will not be allowed any set-off of any loss or the set-off of any brought forward loss against such income, which means undisclosed income as defined in the Act under the proposed amendment will suffer a tax directly even if you have a current year loss or a brought forward loss. Not merely a set-off of current year or brought forward loss, but also of set-off of current year or brought forward unabsorbed depreciation. Current year depreciation, of course, may not be a problem. Brought forward unabsorbed depreciation cannot also be set off, which means that such income will suffer a tax without set off of income. Very quickly dealing with a couple of more amendments. One is with reference to the provisions of 80 IAB, where the provisions provide, presently IAC, I'm sorry, provide for eligible startups to be eligible for reduction in certain cases, where we are extending the time for the startup to 31/3/23, which means that the period of incorporation for eligible startup will now be 31/3/23. Likewise, they are extending the benefit of the 15% rate of tax on companies to companies which have commenced manufacture or production before 31/3/24. This is amended from 31/3/23 to 31/3/24. These are some of the changes which may affect corporate tax. Of course, much has been spoken about the virtual digital asset tax. Well, that can be a separate session by itself, because the way they have defined virtual digital asset, etc., what implications it will have is one question. But I will only restrict myself to saying one thing. Basically, in my understanding, there is a possibility that one can take a view that even a transaction in most of these virtual digital assets are illegal. They are in contravention of the FEMA, etc., can be a view that can be taken. The first point that we need to remember is that they are now trying to amend the provisions of the Act to insert a new 2 within bracket 47 capital A, and to say that a virtual digital asset is also a capital asset, which can result in a capital gains tax on the transfer. It can result in a capital gains tax on its transfer, is what they are seeking to provide for. Now, in my understanding, this does not legalize an otherwise illegal transaction. If the lawmakers feel that the transaction in such virtual digital assets are illegal, the consequence of entering into such illegal transaction is independent. The taxation is going to be also there. That is all. That is my understanding. Now, they have not provided that in respect of virtual digital tax, there will be a flat rate of tax of 30% without any set off of any losses which are arising from the transactions in virtual digital assets, which means that inter-source adjustment, if there is a loss from virtual digital asset transactions, that cannot be set off against income from any other source or any other head. But if there is a loss from one transaction in the virtual digital asset and a profit from another, they can be set off, and on the net 30% tax can be paid. Now, correspondingly, they are also bringing in a TDS on these virtual digital assets, where they say that the person responsible for paying the consideration for the transfer of the virtual digital asset will have to deduct tax at source at 1%. Now, one thing is to tax the transaction which results in a gain from the transaction of virtual digital asset, and another is to impose a TDS, have a TDS obligation on the person responsible for paying. Now, as I understand, most of these virtual digital digital asset transactions are happening mostly from servers which are located outside India. We don't even know where this server is located, which is the enterprise which is dealing with it. Now, to take a classic example, if there is an entity located in Seychelles, and if that entity is going to be the intermediary which is responsible for paying me the money in a transaction on transfer of a virtual digital asset, I do not know whether there can be a TDS obligation on that company. How will they comply with the TDS provisions? How will they file returns, etc.? God only knows. In fact, there is this very old decision of the Supreme Court in Vodafone, where the Supreme Court, if you will remember, Justice Radhakrishnan's observations, where he said non-residents are normally not bound by the TDS provisions. And in fact, they amended Section 195. They amended Section 195 to provide that even non-residents will be governed. There is no corresponding provision in this amendment which is proposed in 194. Yes, that a non-resident can be governed. I do not know how they will monitor this. This can be a very challenging task which can be there for the persons monitoring the requirement to deduct taxes. So, because these may be foreign entities and may not even be answerable under the laws in India to see if tax has been deducted or not. I'll quickly move on to some of the procedural amendments. Now, the first of these, which again was spoken of by the finance minister, is the introduction of a new 139(8)(a), which talks of an updated return. Now, this requires some amount of dwelling into it because it has very far-reaching repercussions. Now, who can file an updated return and within what time? It says an updated return can be filed within 24 months from the end of the relevant assessment year. That is within 2 years from the end of the relevant assessment year. Now, who are the persons to whom the provisions are not applicable? 1, a person who has filed a loss return. 2, a person where such updated return has the effect of decreasing such person's total tax liability vis-a-vis an earlier year or for the same year. If it is going to reduce his income for an earlier year or the same year, he is not eligible to file an updated return. Or 2 or 3, where it results in a refund or where a refund increases, they are not eligible to move or to file an updated return. Updated return can be filed if the original return is filed under 139(1), that is within time, whether it is a belated return or even if it is a revised return. But it is also not applicable to persons who have been searched or requisitioned, or to persons on whom surveys have been conducted, or where my income, say for example, is found in a search belonging to another person, and where I have received notice that a search has been conducted and that my income has been detected. Likewise, this does not apply to persons who are governed by certain acts like the Smugglers and Foreign Exchange Manipulators Act, the Benami Transactions Prohibition Act, the Money Laundering Act, etc. And most importantly, it does not apply to an assessee for an assessment year for which prosecution has been initiated. So unfortunately or fortunately, they have not referred to prosecution in relation to income violation, total income violation. So if, for example, there is a TDS violation committed for a particular year, and if prosecution has been launched for that assessment year, I am barred from filing an updated return. I am barred from filing an updated return is what I can see from the plain language. This is not all. This is what we understand from what we read. But then there's something more which was not said. There is an extra liability by way of additional tax that you have to pay if you want to file an updated return. And that will be if you are filing the updated return within 12 months from the end of the assessment year, 25% of the aggregate amount of tax and interest. If you are filing it beyond 12 months and up to 24 months, then it is 50% of the amount of tax and interest. Now, my understanding is that on the revised income which you are offering through the updated return, 234A, B, and C will apply. So even on the 234C, one may have to pay the additional amount of tax that is to be paid. This was not said by the finance minister. The finance minister said, we are giving an opportunity for you to correct yourself. We will, give you an opportunity to file a revised return or an updated return is what was said. What was not said is that there is no mechanism which they have whereby you will file it without paying an additional amount of income tax. The next change, which was again spoken about, is reducing litigation, or what they call litigation management. What they call litigation management. Now here I don't see much of thing to be discussed in the sense that you already have section 158AA, which provides for something similar. They are only now, in my understanding, seeking to bring in a collegium. Now, what happens is, if a matter is already pending before the jurisdictional high court or the Supreme Court, if it is pending before the jurisdictional high court or the Supreme Court on a similar question of law, then the collegium refers the matter to the AO, and the AO, after taking the consent of the assessee that the issue pending before the High Court or the Supreme Court, either in the case of the assessee for a different assessment year, or in the case of any other person is the same, can approach the High Court or the tribunal to say that they are not presenting an appeal for the time being, and they will present it only after the High Court or the Supreme Court decides. Now, please note that this does not prohibit an assessee from presenting an appeal at his option. It is only a method by which the revenue authorities will not present an appeal. That too, provided the similar question of law is pending before the jurisdictional high court or the Supreme Court, and that too only where there is the consent of the assessee in this regard. Now, there are also some changes made with regard to reassessment provisions. I will not deal with each one of them because there are quite a few amendments, but then they are doing away with certain things where they find them to be a little inconvenient. But importantly, there is one major change in relation to reassessment where they provide that an audit objection would be sufficient for a notice to be issued asking you to show cause why your assessment should not be reopened. Earlier, they said a final objection of the CAG. So two things are changing. One, earlier it was a final objection of the CAG, which means only the CAG audit objections could be taken, and that too only if they are final. Now they are saying any audit objection. That means the revenue audit objection is also now covered, not merely a CAG objection. And B, it is not merely a final objection. Now they are saying any objection will be covered. So these are two major changes that one may have to bear in mind. Very quickly, to deal with a couple of amendments that they are proposing in the context of TDS, the major ones. One major change that they are seeking to make in the context of TDS, is in the provisions of section 194 IEA, where they are seeking to provide that if there is a transfer of a property, the law presently provides 1% TDS on the transfer value. Now, what we are seeking to provide is that the 1% will not be necessarily on the transfer value, but if the stamp duty valuation is higher than the value recorded for sale purposes, that is a transfer value, the TDS obligation will be on such higher value. The TDS obligation will be on such higher value. The second is that they are inserting a new provision 194R, where they say that if any benefit or perquisite, whether convertible into any money or not, arising from the business or exercise of profession by a resident, will also be subject to TDS provisions. It will be subject to the TDS provision. Now, one question that arises is, what happens if an incentive is given in cash in my understanding, 194R, even as amended, will not affect a case where incentive is given in cash. The TDS provision under 194R will not apply. If it is commission, the commission TDS provision under 194O may apply, but 194R will still not apply. Reason being that if you look at 194R, it only talks of a benefit of perquisite, whether convertible into money or not. So if it is not convertible into money, but money itself, that will not be governed by the provisions of 194R. For this, you can take shelter under the decision of Supreme Court in Mahindra and Mahindra Limited, where they, in similar context, in the similar language used in the context of 2084, they said that benefit or perquisite convertible into money or not will not include cash itself. And the last one change that I will touch upon is the amendment that they are contemplating in 2011 and 206C, where earlier a higher rate of TDS was provided or TCS was provided, where an assessee did not file a return, where the assessee did not file a return, annual return of income for any preceding assessment years, any two preceding assessment years. Now what we are saying is we are reducing this 2 to 1, which means only if you did not file the return for the preceding year itself, then the higher rate of TDS or TCS will apply. Now friends, I thought these are some of the thoughts I should share with you. But before I pause here, I think I will once again thank the organizers for the opportunity to share some of my thoughts. And subject to the organizers' convenience, I can take some queries. But I have one request. I may have to wind up my session, which I had informed Mr. Sampath a little earlier. I may have to wind up my session a little earlier. I may log in a little earlier. So if there are any questions, I'll take it at this point in time only. Thank you very much for a very patient hearing.
Thank you very much, Banu. I understood about your other preoccupation. If there are any question, kindly take it for a minute or two. Then you can free yourself. Madam, any questions?
Yeah.
Ask them to put it in chat box so that
Yes, sir.
speaker to be able to attend to that.
Sure, sir. I request the participants to please put it in the chat box if there are any questions. In the meanwhile, we would like to present an e-memento to the speaker, Mr. Banusekar. Thank you very much, sir, for joining us today amidst your busy schedule. I was told by Mr. Sampath Kumar that in spite of he saying that he will come and invite you personally also, you are kind enough to say that, you know, just a phone request is enough. Thank you very much. So kind of you, sir.
Sampath sir is my senior and a good friend, so I would not request him to come and meet me. There's no need.
No, that was so kind of you, sir. Thank you.
Thank you.
Thank you for joining us. And if there are any questions at the end of the program also, we can forward it and request you, sir, for
Sure.
the clarification.
Sure.
Thanks a lot. Thank you so much, sir.
Thank you, ma'am.
Now we move on to the next session. And we have with us CA Mr. R. Subramanian. I would like to introduce Mr. CA Subramanian. Mr. Sampath Kumar, sir, you have anything?
No, I will tell him. He's a good friend. I will introduce in a few minutes.
Yeah.
Subramanian is a chartered accountant in practice for more than 2.5 decades, specializing in tax laws. And he has got his office in Chennai, Bangalore. Wish that he should have in Mumbai also. Though it's a slip of a tongue, he should achieve that. And he's a great friend. Whenever I used to have a doubt, though I don't disturb Banu because I'm in the area of indirect taxes, Subramanian used to give a pointed reference or a clarification or the viewpoint. And to give more time to listen to Mr. Subramanian, there are so many things I can add and tell. And from the time of introduction of GST, he has addressed at least hundreds of trade bodies meeting and the chambers meeting and our CA branches. A voracious reader and a very prolific speaker. I wish to listen from Subramanian today. That's all, man. Subramanian.
Mr.
Yes, sir.
Subramanian, over to you, sir.
Good evening.
Good evening, sir.
Am I audible?
Yes, sir.
At the outset, I am thankful to Dr. V.L. Indira Dutt, President of Andhra Chamber, and Mr. N. Sivaprasad, Sir, Chairman, Direct Tax, and V.V. Sampath Kumar. He is my guru for my indirect tax. I learned VAT only from him. I learned Tamil Nadu General Sales Tax Act only from him. And my co-speaker and a very close friend, Mr. T. Banusekar. Thank you for giving me an excellent opportunity to share my views, thoughts on the Finance Bill 2022, particularly the GST proposal. Sir, the first proposal, section 16, subsection 4. Are you aware that for you to claim the input tax credit, you have to file your GST or 3B in the month of September due date. So that means you have to file it before October 20th, correct? The September month due date is October 20th, correct? So therefore, for you to claim the input tax credit, you have to file your return in the month of September of the subsequent financial year. Say for example, for April 2021 to March 2022, for you to claim the input tax credit, you have to file your GST or 3B before October 20th. Otherwise, you are not eligible to claim the credit. So therefore, whatever the credit you missed, what you have to do, you have to claim it before September 30th return. Otherwise, it will not be allowed. But the new proposal 16.4, now this proposal says that the proposal is extended. The time is up to 30th November. Sir, the reason is one, the income tax return filing, the income tax return is extended October 30th. So therefore, after finalization of the accounts and after audit, we came to know that there are certain credit missed, there are certain mistakes. So therefore, the time is extended in section 16.4. So therefore, once this proposal becomes an act, from the date, you can claim the input tax credit up to 30th November. Sir, it is not a due date of October. It is up to 30th November. Therefore, even if your 3B is related to January 2022, you can file up to 30th November 2022 and you can claim the input tax credit. So this is a first very important amendment, sir. The next very important is section 50 subsection 3, interest. Section 50 subsection 3, interest. Sir, what section 50 subsection 3 earlier says? It says any undue or excess claim of the input tax credit according to section 42, 43 and 43 unmatched credit, you are liable to pay the interest. So therefore, earlier section says very clearly, if it is an undue or excess claim, you are liable to pay the interest. Now section 53, this proposal says very clearly, if there is an input tax credit and if you have availed the input tax credit and also utilized the credit, very important. Sir, I availed the credit. Earlier section 53 says that you have claimed. So therefore, you are liable to pay the interest. Now section 50 subsection 3 says you have to avail and utilize. Sir, I availed the credit but not utilized against my output tax liability. In such a situation, the interest is not applicable. So therefore, section 53 is being amended. Now it says input tax credit availed and utilized. If you have availed and utilized, then only the interest. If you have only availed and not utilized, then the question of interest will not. And then this is a retrospective amendment, sir. Very important is this is a retrospective amendment from 1/7/2017. This is a retrospective amendment from 1/7/2017. The next very important is the rate of interest is also reduced to 18%. The rate of interest is also reduced to 18%. So therefore, the rate of interest is 18%. You have to claim the credit and utilize. Then only the interest is applicable. This is a retrospective amendment. Sir, what happened the earlier provision? The earlier 650 subsection 3 is being omitted. Omitted. This is a new section with retrospective effect from 1/7/2017. Very important, sir. Very important. Sir, I paid the interest. I paid the interest under the earlier provision and I paid at the rate of 24%. Now what I have to do? Sir, my view is that you can claim the refund. My view is that you can claim the refund. So therefore, this is a second important amendment, sir. This is a second important amendment. The third very important amendment is section 41. Very disturbing amendment. Very disturbing amendment. The section 41 is a third amendment. What the section says very clearly. Sir, earlier, you are eligible to claim the credit on a provisional basis, sir. On a provisional basis, you are eligible to claim the credit. Now, section 41 says, no, on the self-assessed basis. What do you mean by the self-assessed basis? You can work out your tax liability. You can take your input tax credit. You can find out your output tax liability. And then you can work out your tax and then pay. So therefore, section 41, earlier it was a provisional basis. Now it says on a self-assessment basis. Now it says on a self-assessment basis. So therefore, you can claim input tax credit on self-assessment basis. On self-assessment basis. Now section 41(2), it says very clearly. 41(2) says very clearly. Very interesting. It says very clearly. If the supplier, sir, I purchase a goods from Mr. Sampath Kumar for 1 crore and the rate of tax is 18%. The rate of tax is 18%. So 1 crore 18 lakh rupees I purchase a goods. Sampath Kumar not filed the return. He has not paid the tax. Now the act says, now section 41 says, I have to reverse the credit, sir. Now I have to reverse the credit. Just because Sampath he has not filed the return and he has not paid the tax, the act now says, section 41 now says, through this proposal it says, I have to reverse the credit, sir. I have to reverse the credit. This is against a various judgment. The judgment, even the Madras High Court judgment, Brithel Enterprises, and another is here, Ranganathan Walson Limited. There are certain decisions. It says that the recipient should not be punished. The recipient should not be punished for the fault or for the mistakes committed by the supplier. Now this proposal says, if the supplier not paid the tax, then in such situations, I have to reverse the credit, sir. I have to reverse the credit. Sir, not only reversing the credit, sir, not only reversing the credit, I am also liable to pay the interest. I am also liable to pay the interest. So therefore, I have to reverse, assuming that I purchased goods in the month of January, and in the month of June or July, I came to know that Sampath is not filed the return, or the department came to know that Sampath is not filed the return. Then in such a situation, the department, they can come straight away to me and ask me to reverse the credit, and also ask me to pay the interest, So therefore, this is to be represented to the government. This chamber also, they have to represent to the government, because it is not the fault of the recipient. The recipient is already paid the tax. The recipient already paid the tax along with the consideration to Sampath Kumar. So therefore, the Sampath Kumar not filed the return. Sampath Kumar not paid the tax, but the act is asking me to reverse it. The act is asking me to reverse it. The next very important, sir, once Sampath Kumar filed the return, the act says, I can reavail the credit. But what happened to the interest, sir? It is silent. What happened to the interest? I already paid the interest. Sampath Kumar also, what he is going to do? He is going to pay the interest also, because he filed 3 months late. But he is going to pay the interest also. I also paid the interest. So therefore, this is to be represented to the government. This is an far-reaching amendment. So therefore, this we have to represent to the government, sir. This is the next very important amendment, sir. The next very important amendment is, sir, Section 38 of the CGST Act. Sir, earlier Section 38 is totally omitted. What the earlier Section 38 says? The earlier Section 38 says, it talks about the inward supply that you have to file it. It talks about the inward supply. Sir, I purchase a goods. I have to verify whether it is correct and whether the supplier he has properly uploaded. If there is any mistake, I can communicate to him. So these are all Section 38. These are all Section 38 related inward supply. Now this section 38 related supply is totally omitted. The reason is GSTR1, GSTR2, GSTR3 is omitted. So therefore, section 38 is also being omitted. So now we have only two written. One is a GSTR1, another one is a GSTR3B. No question of GSTR1, 2, 3, communication, online reconciliations, all those things is being scrapped. So therefore, now what section 38 says? The new section 38 says, very interesting. The new section 38, it says that you should be communicated to the recipient, then only the recipient is eligible to claim the credit. So that means, sir, the supplier, he has to file the return. The supplier, sir, I purchased goods from Sampath Kumar. Sampath Kumar, he has to file the return. He has to file the return, and he has to communicate, to the recipient, to me, through GSTR2B. So through GSTR2B. So based on that only, sir, based on that only, I can claim the credit. Based on that only, I can claim the credit. Based on that only, I can claim the credit. Now what section 38 says? Section 38 says, we will also put certain other condition also. We will also put some other condition also. What are all the important conditions? One, if a person is a newly registered person, if Sampath Kumar is a newly registered person, if I purchase from Sampath Kumar, sir, then in such a situation, I may not be eligible to claim the credit, because the act says we will prescribe in respect of a new registered person. We will prescribe in respect of a new registered person when you can claim the credit. So that is a point number one. The point number two is very important. Is that if Sampath Kumar not paid the tax, when he contravened to the provisions of the act, I am not eligible to claim the credit. I am not eligible to claim the credit. When Sampath Kumar, he claimed the more credit than what he is entitled, then even in such a situation, the act says I have to reverse the credit. Even in such a situation, the act says I have to reverse the credit. And fourth, very important, sir. Is, sir, that proportionate credit, rule 86B, 99% of the output tax liability. Sampath Kumar, sir, he has to discharge only 99% of the output tax liability through input tax credit. The balance 1% he has to pay by cash. If he has not paid by cash, then in such a situation also, as a recipient, I have to reverse the credit. So this is section 38. So therefore, the old section 38 is being removed. The new section 38 puts me a lot of conditions, saying that for claiming the credit, I have to fulfill all those conditions in section 38. Sir, simultaneously, the section 16 is also being amended. Section 16 is also being amended. All you aware that section 16 WA is already being amended, and it is effective from January 1, 2022. January 1, 2022. It says that supplier has to furnish the return. And it should be communicated to the recipient. Then only you are eligible to claim the credit. Indirectly, the section says that if it is auto-generated in GSTR2B, then only you are eligible to claim the credit. Even if it appears in GSTR2A, but not appear in GSTR2B, you are not eligible to claim the credit. From 1/1/2022. Now, the section 16.2 is further amended. Section 2B, it says that for you to claim the credit, the supplier has to file the return. One. Second, it must be communicated to the recipient. Third, very important is, it should not be a restricted credit in section 38. Restricted credit, which we have already discussed. So therefore, if it is a restricted credit, then even in such situations, you are not eligible to claim the credit. So therefore, this is a major amendment in section 16 and section 38. The next very important is for you to raise a credit note. So in respect of the supplies made earlier, for you to raise an credit note, there is a time period. The time period is up to 30th September. Of the subsequent year. Sir, for March 2022, you have to raise a credit note before 30th September 22. Now the act is relaxed. Now the act says it is being is extended to up to 30th November, up to 30th November. So therefore, now you have another 60 days time period for you to raise the credit note, for you to raise the credit note. Same, sir, for you to rectify any error in your return. For that also the time period is 30th September. That also being is extended to up to 30th. That also being is extended up to 30th November. That also being is extended up to 30th November. So that is a very important. And then the next is in respect of a cancellation of the registration. In respect of a cancellation of the registration. In respect of a composition dealer. Composition dealer means a dealer who opted to pay tax under Section 10 of the CGST Act. Under Section 10 of the CGST Act and pay the tax at the rate of 1% or 2% on the outward taxable supply without claiming any input tax credit, and they should not collect any tax from the customer. So these are all the type of a dealer is called as a composition dealer. So those composition dealer for cancellation, earlier, if they have not filed the return for 3 consecutive tax period, the registration will be cancelled. Now it says that they can take another 3 months from the date of filing the annual return. Sir, they have to file the annual return before 30th of the subsequent year. From that, another 3 months is allowed. So therefore, for the composition dealer, the cancellation time period is extended. For other type of a dealer, the bill says that they will prescribe the time period. The bill says that they will prescribe the time period. That is in respect of the cancellation of the registration. In respect of the cancellation of the registration. And then very important is in respect of a non-resident taxable person. In respect of a non-resident taxable person, earlier the time period is 20th of the subsequent month. Now the time period is reduced to 13th. Reduced to the 13th of the subsequent month. Now the reduced to 13th of the subsequent month. Sir, I already discussed regarding sections 41. And then very important is section 42, 43 and 43A. Section 42, 43 and 43A. So section 42, 43, 43A, it talks about the matching, reversal and reclaiming on the input tax credit and communication. Sir, now GSTR1, GSTR2, GSTR3 is being removed. Therefore, the simultaneous section is also being removed. Section 42, 43, 43A is also being removed from the statute books. Therefore, only the 2 return, one is a GSTR1, another one is a GSTR3B. No return is called a GSTR1, 2, 3, online reconciliation, communications. All the thing is being omitted now. All the thing is being omitted now. So, so these are all the very important provisions related to the Finance Bill 2022. I think I almost covered the important aspects related to the Finance Bill. I am also noticing Mr. M.R. Venkatesh, sir. I also wanted to hear his speech. With this, I conclude my presentations. Thank you for all of your passion.
Thank you, sir. Thank you very much. Now, I would like to introduce, I would like to first welcome Dr. M.R. Venkatesh. Thank you, sir. Thank you for joining us amidst your busy schedule. I know that you have been having back-to-back sessions. In spite of that, you have joined us. Thank you very much, sir. Before we proceed with this session, I would like to briefly introduce Dr. M.R. Venkatesh. Of course, he doesn't need much of an introduction because the audience here knows him very well. But still, it's customary on the part of the chamber. Dr. M.R. Venkatesh is one of the India's leading advocate on economic criminal laws. He has handled several legal matters and appeared in various forums in matters relating to PMLA, FEMA, income tax, Benami laws, Black Money Act, customs, WTO related issues, GST, IBC, and company law. A much sought after legal consultant, he has been an advisor to several corporates on complex transactions involving cross-disciplinary expertise. He has been one of the forerunners in India in the field of fighting black money, and his book titled Sensex and Sentiments has been acknowledged by experts as one of the pioneering works in the field of anti-money laundering. A ranker in the final examination of the Institute of Chartered Accountants of India, he is well recognized for his professional integrity and acumen. MRV, as he is fondly called by friends, is a rare breed of advocate who brings a trans-professional approach. He is also a commerce graduate and qualified management accountant with a great understanding of economics, law, and accounting. MRV is at once an advocate, chartered accountant, management, accountant, economist, author, and columnist. Mr. M.R. Venkatesh has recently completed his doctoral thesis with Shastra University. He has taken to law practice in 2018 after 25 years of practice as a chartered accountant. Mr. M.R. Venkatesh is prolific and well-known personality, and his writings are regularly featured in prominent dailies and magazines. He has authored so many books. With this introduction, I would like to welcome Dr. M.R. Venkatesh to please present us the economic scenario of the budget. Over to you, sir.
So good evening, friends from Delhi, and I'm particularly thankful to Sampath Kumar for having ensured that I'm here. He virtually threatened me with an income tax notice and got me to speak here. I was held up in some other chamber. I had given them my word, but he ensured that I was. I virtually dropped the proceedings there and came back here at exactly 6:15 before the time in which he had told me. So thank you very much, because the reason why I came here is very simple also. That when the Parliament convenes to pass the budget, one of the important questions the Finance Minister has to address the Parliament is whether MRV has spoken in the Andhra chamber, and did Andhra chamber invite him. And that is how the budgets get passed. Otherwise, the budget will be having a technical flaw in not getting passed. So in that way, I must, what Sampath has done is to bestow his gratitude to the Parliament for and ensuring that the budget gets passed. Now to the economic aspects of the budget. Party of the budget was like a visionary document of somebody who wants to look at the next 25 years. The Prime Minister has presented it as Amrit Kal. So what we could talk in Tamil as Purkalam, some sort of a huge awakening that's going to come in the next 25 years. And all of us are filled with pride. And true to her, true to this vision, it was more or less a vision document, that she talked about something phenomenal, about digitizing. In fact, I'm sure I didn't join Subbu's presentation, but I'm sure it was about 38, where they converted the entire goods and service tax into an information technology procedure. It is now, whether you sell, buy, whatever you do, you are governed by the flow of input credit and output debits that you will have to maintain without your control. It is on an autopilot. Virtually, it is on an autopilot, and that's how they are changing. Digital India, digital currency, cryptocurrency taxation. It was like watching an interstellar movie, where Star Wars movie, where somebody is attacking us from alien planet and we are shooting off some missile. And suddenly, when we thought we are watching an interstellar movie, there is a Pan Parag advertisement. Suddenly, you see that the Finance Minister comes and talks about it, hike in the custom duty of a umbrella. I don't know, this fascination with umbrella started with 2004 or 2005. I think Subbu can bear me out, where 1 year they raised the custom duty of umbrella and dropped the custom duty of walking stick. Next year, they reversed it. They raised the custom duty of umbrella and dropped the custom duty of walking stick. It looks like umbrella and walking sticks are alternatives for the government. So to put it very bluntly on a very macroeconomic plane, it is a vision for the 21st century, prepared with the 20th century mindset and allowed to be operated with the 19th century bureaucracy. This is the budget in short. Now I'll take just 2 amendments. The amendment to 68, I don't know who was the speaker on income tax. I am sure he would have dealt with it. Sampath,
Banu.
He would have dealt with 68 because yesterday morning he woke me up at around 7 o'clock and started discussing this. For us in Delhi, 7 o'clock is midnight. For you guys in Chennai, it is half day. Without realizing this, he called me and had a discussion on that. 68, I think, is reflects the mindset of this government, that every taxpayer, unless does an Agni Pariksha, it's a doubted character. and he has to walk through the Agni Pariksha, he or she has to walk through the Agni Pariksha. And 68 is not only you have to satisfy the source, you have to satisfy the source of the source also. And God forbid, it may go source of the source of the source also next year. So to this extent, they have amended the law. Now, as far as the budget, now let me come to the issues in the budget. Now, what I see from the mental makeup of the Prime Minister, and obviously reflecting in the budget speech of the Finance Minister, is that the Prime Minister sees himself as Franklin Roosevelt of the war-torn USA and the recession-hit USA. Roosevelt was the president between 30s and 40s. And he was one of the most successful presidents. And even today, if you ask an American, which are the three presidents whom you think is the greatest president you ever had, they would obviously talk about Lincoln, talk about George Washington, and about Roosevelt. And why Roosevelt? Roosevelt was heading one of the most toughest periods of the economic history of US. There was a great recession in the 20s. Then there was a war which started in 30s. And of course, it culminated in the victory of the forces, American forces, and that he demonstrated during the toughest period. He only had 3 R's as a formula. The 3 R's were relief for the poor, reforms in the financial sector, and recovery of the economy through spend in capital expenditure. This is the mantra he had. And if you close your eyes and look at this budget 22, you have relief for people who are hit by pandemic, who are poor, who are downtrodden, who are in need for support. There is a good measure of support for the downtrodden people, for those who are in some distress. And as far as the financial sector recovery is concerned, more or less, we have come to a conclusion that financial sector reforms at this point in time have reached a reasonable destination point. Banks have been recapitalized. The NPA sob story is behind us. We are now on a path of credit lending by banks that is going to start, and that will start only when the virtuous cycle of private investment will start, and the private investment will follow the capital expenditure program of the government, and the government spend is what it is. So the government has already decided that it will spend 111 lakh crores on infrastructure pipeline, which was announced on 31st December 2019 by the Honorable Finance Minister. 2 years have passed, and this year they have taken a huge stride by announcing that we will spend roughly around 7.5 lakh crores. That is humongous. And on top of it, on the defense capital expenditure of around 1.6 lakh crores, they say 68% shall be procured from India. So these are two big things that are happening on the positive side. So this will give you a huge fill up, and I'm sure that people are going to benefit from it. But there are specific concerns. The two concerns that have come about are one, which is a perennial one on the personal taxation, whether relief could have been given, more of relief to people in the salaried class who are the most honest taxpayers, not because of any characteristics, but because by default TDS is being deducted, and so they are the virtuous, the most honest people. And so could there have been something done for them? And two is for the MSME. Now, for the first bucket, namely the taxation, tax-paying individual, the finance minister gave accolades, congratulations, quotes from Mahabharata, quotes from Bhagavad Gita, and said, good luck to you. Now, what I could understand was, she quoted from Mahabharata, chapter 11 of Shanti Parva, where Bhishma Charya was lying in a bed of arrows. And it would seem that it is the Indian taxpayer, instead of Bhishma Charya, who is sitting on, sleeping on a bed of arrows. Apart from a motherly advice and motherhood statements, I could not see anything in the budget for the honest taxpayer. The second thing that I found very interesting was that the lack of thrust on MSMEs. Now, as I said, the umbrella story doesn't stop at the beginning. It also comes now. Now, why did you raise the duty for umbrellas from 10% or whatever it was to 20%? Now, one of my friends called and told me, don't you understand what she has done? She has done a very big thing. She has challenged the Chinese imports by raising custom duty on umbrella. So a $18 trillion economy, which is the Chinese economy, is going to be, derailed by raising the umbrella custom duty from 10% to 20%. Now, the analysis of the budget is also so pathetic. Unfortunately, in this country, nobody understands. I think at least several, I didn't count the numbers, but there were hundreds of products on which customs exemptions have been withdrawn by this government, and this has been happening for the last 2-3 years, and that is the way to go about it. Here we can't be giving customs exemption for a variety of things, and we are withdrawing so many of these things, and in line with our WTO obligation also, we are also reducing the taxes and also withdrawing the exemption. This is how it should be. But the core question of MSME is that they have to wait for government spending. Government spending will be to the large ones like L&Ts, like Tatas and others, and they will have to wait for these companies to now downstream the whole projects and start spiraling down effect or trickle down effect, as they call in economics. And that is how they think that the MSME has to build in, apart from the 2 lakh crore enhancement in the credit guarantee that they have promised. But what is worrying me is that in 2012, Dr. Manmohan Singh pointed out to a very big structural imbalance in the national economy, which is that the manufacturing sector share of GDP was at around 15% in 2012. And he pointed out that we must reach to 25% by 22, that is now. No economic miracle has happened unless manufacturing has touched 25% share of the GDP. Whether it is South Korea, Japan, whether it is Thailand, whether it is Philippines, whether it is Indonesia, the so-called East Asian giants have pivoted their economic growth on manufacturing. Just like we did not have landlines and everybody had cell phones. We short-circuited the telephone revolution by bypassing the landline revolution. We straight away came to mobile phones. Likewise, we want to grow without developing our manufacturing and short-circuiting it and going to digital revolution. It is like putting after first standard a person to CA final examination straight away. Now you write CA final and pass. Now everybody is digitalized. This cannot happen. This can happen with some of us. Some of us are endowed with the natural ability to deal with this, but I do not know how people can manage this as, without short-circuiting manufacturing. How can you make an economic superpower? How will you emerge as an economic superpower? Now, our share is stubbornly at 15%. To make it 25% will be a panacea for several of your ills, including social sector, employment growth. It will be for revenue growth also. It will have a spiraling impact both on manufacturing and on services. Several things will happen. Unless we quickly raise the share of manufacturing in the next 5-7 years to 25%, I think India will be condemned to be a middle income economy, and we will have tinkering of GSTs, we will have tinkering of section 47 and 45 of the Income Tax Act, and probably we may give the 5 years down the line, we may have an exemption limit up to 3 lakh rupees and we will be go gung-ho about it. We will still be a middle income economy. We will not think big. Now, let me come to this digital rupee. Now, every other cryptocurrency is not is termed to be a digital currency, except Indian rupee, which will use the blockchain technology. I have no issues of that. But when I send, say, 100 rupees to Sampath by RTGS, is it not use of digital, but not using blockchain? I am using it only digitally. My 100 rupees credited into Sampath's account, debited in my account and credited in say Sampath's account, is basically nothing but use of digital transactions and digital currency. And he has a choice. He can keep it in his bank, which are all kept in digital currencies only. And if he wants to withdraw, he can withdraw physically, that 100 rupees. So digital is the default position today. Physical is basically the alternative or the, or shall I say the secondary position. But I don't know what they are trying to say. RBI will introduce a digital rupee. They have not given a roadmap. I am also confused. But I can tell you one thing, that those who are going to honestly go about pay their 30% tax on transfer of cryptos, bitcoins and others, they are going to get a rude shock that the government is going to come down heavily on them for FEMA violations also. Everybody is violating FEMA and right royally buying cryptos. And there are some Tamil Nadu ministers who are showing their way. And if local press is to be believed, some Tamil Nadu ministers have invested up to 52 crores in cryptos. So you can understand who is supporting cryptos and who is not supporting cryptos. So whether you legitimize it or not, the politicians have already legitimized it. It's only a question of recognition by the tax department. Now, if you go back, the question therefore is, since it is being taxed, is it legitimate? Now, those of us who have read the Vinchada judgment of the tribunal in Bofors, in the income tax tribunal case, the question was whether Vinchada got bribed on account of the Bofors gun scam. Was a matter of debate that went on. But the tribunal said, though the courts have not proved it beyond any doubt that you have taken in bribes or not, preponderance of probability is that you have already got this money, so we are taxing. So if you just look at the analogy and take the ratio forward, the income tax department is not bothered about the legitimacy or illegitimacy. If you sell ganja also tomorrow and you make a profit, you are supposed to pay tax. Only thing, there is no TDS provision for that or TCS provision. Otherwise, you have to go about, you can say, show it as unexplained income, and then you may say that I'm sorry, I'm not able to explain the source of the income, and you may have to pay the tax. But tax you must pay. The department is not bothered about distinguishes between legitimacy and illegitimacy. And since you have paid tax, you cannot say I can deal with narcotics. So this is very clear. So on this, I think there should have been no confusion. Now on the numbers, if you look at it, the total revenue receipts that the government has projected is around 20 lakh crores this year. And it goes up to 22 lakh crores next year, budgeted by around 5-6% only growth. When the growth will be around 8% and inflation will be around 5-6%, and buoyancy always expected at 3-4%, on a simple thumb rule calculation, if you get 100 rupees today as income, next year you must budget at 116. This is a golden thumb rule every finance minister follows, and conservatively they may give up on inflation. Okay, it will not be 6%, I will have it 4%. If not, growth will not be 8%, it will be 6%. Okay, 6 plus 4, 10. Buoyancy will be at least 2%. So 12% at least they usually put it. But I'm finding that the gross numbers are being projected at only 6%. That means inflation plus growth plus buoyancy, will it be only 6%? Is the finance minister too overcautious? Is she being conservative? Or is she fearing that let us err on the side of caution because we have not yet come out of the COVID circle? Let us wait till good days actually emerge. Now, a couple of things that have escaped the general scrutiny of the budget is one that they have increased the spending on Jal Jeevan Mission, which has reached to 60,000 crores. Now, last year, which is 2021, it was just 10,000 crores. It has increased by 5 times. From 10,000 crores, they are reaching up to 60,000 crores. This is something stupendous. Likewise, if you see that the Manrega provision has also dropped. Manrega provision has come down from 98,000 crores, which they expect to spend this year, to 75,000 crores. I think this is another good thing, because this again tells you that the government is confident about growth, that their economy will have a growth potential. And once there is a growth potential that is actualized, there will be an employment generation, and automatically things will flow from that. I think this is excellent thing that if Manregas and other things get cut and actually people don't line up, then that means it's good augury. It means that people are lining up for employment and they are getting employment elsewhere. As far as capital expenditure of 7.5 lakhs, something which again seems to have missed the Indian media's eye. And like good things, they don't seem to see the good things in any budget. One of the biggest thing that I see is the atomic energy push in this budget is to the extent of 14,000 crores on the capital expenditure. That is something which I always wanted. Big amount money being spent on capital account expenditure in atomic energy. Then telecommunications, 5G. I am told that only US and China are the two economies which have got the 5G technology rollout. We will be one of the handful of nations if we are able to roll out 5G this year on a mass scale without disturbing the flights. Of course, that is a worry that people are now saying that the aircraft communication system gets disturbed or interfered with. But subject to that, I think we have to be a proud movement, and we are spending around 55,000 crores on that. Then on Ministry of Defense, 160,000 crores on capital expenditure, of which 2/3 roughly will be spent procurement in India. Now, I would like to see we should reach the percentage of 80% very shortly. If we reach 80%, I think we have reached a threshold, then we will become big exporter of arms, which is going to earn foreign exchange for us shortly. Then police modernization, 10,500 crores. I can tell you with some amount of authority, even in a murder scene, there is no uniform procedure and kit available to our police to collect forensic evidences. So each police collects it in a different way. And when it comes to the high courts, people question the manner in which the forensics are collected. And that creates a huge problem in conviction of convicts. And that, I say, is one of the stumbling block is the police modernization, of which even something as elementary as kits for forensic is not available. I think we need to go ahead and spend enough money on these type of things, which is what the government does. Railways, they are spending 1,37,000 crores. And if you are near Perambur, all your properties are going to go up. Mark my words, this is North Chennai is going to get biggest boost of this particular spending, especially the Vande Bharat trains, which are getting planned to be manufactured in Perambur. Roads, 187,000 crores. Now, if they are going to actually spend it, my doubt is that they are not able to spend it because of bureaucratical inefficiencies, our judicial interferences, our lethargy. If we are able to walk the talk of the budget expenditure that we have planned, I'm sure that we will do something phenomenally well. And then let me come to the last part of the budget, the fiscal deficit. Now, the fiscal deficit plan for this year, 22-23, is around 16,61,000 crores. Now, Government of India is going to borrow 16 lakh crores from the open market this year. That, I presume, will have a very significant impact on the overall financial structure, because that will crowd out private borrowings, and government is going to be the single largest borrower. The interest rates, in my view, will harden this year. Second thing is US has been threatening with rolling back the quantitative easing that it has announced. That will have a very significant effect, and I'm very confident that one day or the other, US will roll back. And once US rollbacks and raises its interest rates, already inflation in US is around 7%. In UK, it's around 5.5%, 6%. In India, it is around 10%. If I think the biggest economist in terms of food grain inflation, vegetable inflation is the lady in the house. And I've got two ladies, my mother and my wife, and they tell me it is 10%. If RBI or finance minister says something, I'm not going to believe them. And they are telling me it is around 10%, which is frightening and worrying. And that is creating a cascading effect. Just two numbers before I close. I think I have taken enough time and I will close quickly. One is the primary deficit. The primary deficit is 7.2 lakh crores, which means our expenditure exceeds our income even before considering interest to the extent of 7 lakh crores. Now that is worrying, which means our total expenditure on interest is around 9 lakh crores on a 40 lakh budget, which means roughly around 25% of our expenditure is on interest. 25% of interest is not sustainable for any economy. Our gross debt has crossed 135 lakh crores. That is unsustainable at this point in time. Our debt to GDP ratio is around 90%, according to some economic surveys and various international figures. We are frighteningly close to a debt trap, if not in one. Our only way we can escape this is to grow rapidly, not at 8%, not at 9%, something we must aim at 12%. We must double our income every 6 years. Unless we grow at 12%, I think we will be leaving a very sorry state of affairs to the next generation. I hope this budget, I hope the Prime Minister's vision, I hope the Finance Minister's sagacity will guide us to a better tomorrow. I hope the manufacturing sector will revive. I hope there will be enough job employment for this millions of people who are queuing up. I hope that the economic philosophies adopted by the government will work. If it works for 8%, 9% growth, I am not so sanguine. I would be happy with the 12% growth. Will it happen? I will have to keep my fingers crossed. I know there is a hydraulic pressure created by the COVID lockdown and several other issues. But quickly, if government doesn't do anything for 12% growth, I would consider myself having done precious little for the next generation. With this, I will stop and thank you all for a patient listening, and thank you, Sampath, for inviting me. And I'm sure the budget will be passed.
Madam?
Yes, sir. Sir, there are a couple of questions.
Yes.
Paddy.
To Mr. Venkatesh. As a fallout of the COVID-19 pandemic, a lot of global firms started relocating themselves out of China, Vietnam, Indonesia, and Thailand, seem to have benefited from the ongoing relocation process, but not India. Your views on what India should do to attract the relocating industries?
If rough estimates of macroeconomic indicators are any pointers, you take it around $5 trillion worth of manufacturing wants to move away from China alone. Now, is India your destination target? Is India offering an alternative? Now, I had a discussion with, I may not be an expert like Subbu is on, say, GST, but I understand GST to explain to a potential investor. When I told him the complications, he erased India from the destination point. The complications that we have, say this time we have introduced Section 68. The manner in which we have complicated 68 is humongous. We have brought changes. 147, the retrospective, the reopening code was well settled. I don't know why we disturbed last time. We went to the court. Courts have virtually smashed all reopening. And now we are left with tinkering 147 all over once again this time. We don't know what is the exact impact. We have to wait for it. So the point I'm trying to say is India is a potential investment target perennially. Not today. Right from 50s, 60s, we have been talking since Nehru's time that yes, this is a wonderful destination point. but we are not able to actualize it, because if you tell the foreigner the type of rules that we have, the regulations that we have, then people get frightened about it, because if something happens, straight away prison. It is the erstwhile labor laws had a wonderful way. 5 rupee fine or 6 months imprisonment or both. I can't find 50 rupees or prison or both. This was I'm sure somebody would have read the Industry Dispute Act and other things way back when we were. This is the mindset that we have. Everything we have to penalize people with fine or imprisonment or both. So this continues. That is why I said we are having a 19th century bureaucracy, 20th century mindset, but we want to have a 21st century. We want to have all this 5 trillion coming here. But the moment we are going to allocate land, then you have state government creating problem. And believe me, there are enormous amount of state government involvement in attracting manufacturing investment. It is not only central government is involved. Now you had this nano investment of the Tatas in Shingur. Now, the way the West Bengal government handled it, Mamta handled it, then CPM handled it, is a lesson for all of us that don't venture into manufacturing in India. That is why we are stubbornly at 15%. We are not able to grow. And what is the answer to this? We have brought in PLI, productivity linked investment manufacturing schemes. And believe me, for this $75 billion of trade deficit with China, we are going to spend 182 crore PLI this year. And next year it goes to 1,600 crore. With 1,600 crore, you cannot attract global investments. We must say, we are ready to give you land. We are ready to give, these zones will be zero or very minimal labor laws, free exchanges, no capital restrictions on investment, no FEMA regulations will apply. And then you start looking at these type of zones with absolute impeccable infrastructure. Unless you give this, China built infrastructure from 78 to 95 and then started getting $60 billion. I recall 97, Chidambaram telling us, India gets not even $2 billion of FDI. China gets $60 billion. We are very angry about it. We are very upset about it. Today we get $60 billion after 25 years. So we want to do things within 4 or 5 years. We have an aspiration of the 21st century, but it's the mindset of 20th century with that 19th century bureaucracy.
Okay. Thank you, sir. I think there are a couple of questions for Mr. Subramanian. Yes. It's about 5 years. One, Mr. Jairaj has posted this. It's about 5 years since GST was introduced. Have the objectives of higher collections and ease of business realized? In what ways could GST be fine-tuned to help India become $5 trillion economy?
Sir, according to me, the cascading effect, so if you see the amendments, particularly the latest amendment in Section 16(2) and as well as Section 41. Now I am seeing from, seamless credit to see no credit. So that type of amendment is came. So therefore, the objective of seamless credit is not being achieved. That is by my view, sir. That is my view.
There is one more question, sir. You mentioned that supplier need to communicate. Once he files 3B, it will reflect in 2B of buyer. Please let me know what you meant by communication.
Sir, that the latest amendment, from January 2022, the Section 16AA of the CGST Act is being amended. It says that for you to claim the credit, the first condition is the supplier has to file the return and it must be communicated. The communication the portal will do. So the portal will generate GST or 2B. The portal will generate GST or 2B. You can take the credit only from the GST or 2B. If the particular supplier not filed the return, then it will not come into the GST or 2B at all. Therefore, you are not eligible to claim the credit. So therefore, the communication, it automatically will be generated in the portal. That is particularly the form number GST or 2B for you to file a return and claim the credit. Each and every month you have to verify your GST or 2B. And then accordingly you have to take the credit. That is from January 2022.
Okay. Thank you, sir.
Yeah.
Are there any other questions from the participants here?
I have one question, madam.
Please, sir.
Mr. Venkatesh. I have a question for Mr. Venkatesh.
Namaskaram, sir. How are you?
Namaskaram, Mr. Venkatesh. How are you? Good to see you again.
Thank you, sir.
Mr. Venkatesh, I have a question. It might be considered a little sensitive, but I shall leave it to you whether to answer it or not. Now, my question is, for all these estimates of growth in GDP, 8%, 9%, 10% on the one hand, on the other, the government has been very, very active in the last 3 or 4 years, about the black money in the economy and then the underground economy, and trying to drive the underground economy out into the open. So isn't there a possibility that what was formerly underground economy, which did not or was not counted for the GDP, now is becoming official, coming into the reckoning and getting into all the statistics, and this so-called 8 or 9, 10% growth, a part of it is probably already existing, but got a different, coat of paint. Is it possible?
It is. Supposing tomorrow you legitimize narcotics sale and withdraw the narcotics law, I think Shah Rukh Khan will be happy about it. But let us assume for a moment that the narcotics law is removed. You will see that the national GDP goes to this extent of the narcotics sale. It is what you say is absolutely logical. You are accounting the unaccounted. Very true. But has it really happened? This year's budget, when you look into the fine prints about the money that the Black Money Act would have brought in, this year is 0, next year is 0. That means the Black Money Act, which you and I are so very conservatively advising our clients to do this and do that, the hen has refused to lay the egg. So it is virtually there in the shelf, in our shelf, your shelf, as a statute. But where is the black money and where is it getting penalized? Are you saying that everybody has come formal, everybody has become absolute clean with their books and there is no black money in this country? So on one hand, I appreciate what you are saying, yes, but the other hand, there is large chunk of black money. That's what I said. One Tamil Nadu minister, he is having 52 crores as cryptocurrency. It's not black money. It's only one part of his asset is in cryptocurrency. So this cryptocurrency is a huge parking lot for your black money. Likewise, it still exists and it will continue to exist. You can eliminate everything but not black money.
So the point is, we have always had this, along with the GDP, we also have these figures, because I don't know, they're very, very difficult to compute. The comparable, the purchase power, purchase parity figures.
Yes.
In other words, your total economy is equivalent to the official GDP plus what is not officially reported.
Yeah.
So I don't know how far that figures are accurate or reliable, but I haven't seen any recent figures, because if we put both these figures together, we should be in the top 5 countries in the world. I think that's what the...
Sir, if you convert, we are now supposed to be the 6th largest economy in the world. But if you add it, if you compete through the PPP model, we are the 3rd largest. We have overtaken Japan, we have overtaken UK, we have overtaken France. Many of these economies we have overtaken. When you can say with using the PPP model, we are number 3.
I have one more question. You did mention about the fact that the government is going to be a big borrower in the market, and then it's going to crowd out the private sector, because then I think it's going to be in that situation. And also this particular appeal or whatever, a lot of middle class have been agitating for this, especially those who have retired and who have seen their income going down because of the fact that the interest rates on deposits have gone down substantially, which are standing ridiculously low. As a matter of fact, your rate of return is actually negative. Yes. If you were to take into account inflation, because your rate of return is lower than the inflation rate. So actually, by depositing money, you're getting a negative return. So given the fact that the government is going to be the biggest borrower, and also the private sector is going to be a huge borrower because of the PLI, etc., eventually, money is going to be dried out, which means there will be a huge competition among the banks for raising deposits, which means, okay, I'm not talking about the fact that the Reserve Bank of India may, print more money, whatever it is, I don't know, I'm not talking about that. But the point of it is eventually money being a scarce commodity, rates of deposit have to go up in the short term, at least. I mean, the near term. I mean, I'm talking about something like 7.5%. Is it feasible?
It is technically feasible. That will be a healthy sign that the economy has bounced back also. In the sense, if your BP is too low, that means it's not good. It must rise up, and a bit of inflation is a suggestion that the economy is bouncing back, and concomitantly, if the interest rates also goes up, that would actually pull up our savings. Unfortunately, what has happened is the savings rates have dipped in the last 2 years very badly, last 2-3 years. So current year, of course, they say that this is improved, but last 2-3 years, it has gone down very badly because of this particular reason. And if you look at it, of course, you know it better than me, that the SLR at 24% is one of the biggest suppliers of money, and households are the biggest suppliers of money to the bank, and from bank to the government. So this is the easiest route that the government takes deposits from us and spends on our welfare and fiscal deficit. So this chain, we have to break it, because unless we break this chain, the budgets will be less meaningful.
Then, if interest rates on deposits go up, and then bankers always typically look at a 2% to 2.5% spread, for the lending rates. Generally that's how it works out. So you're really talking about 10%, 11% lending rates for the banks, which means that again is going to be inflationary along with the other factors.
Sir, the answer to this is by underpricing interest, capital cost. You are not actually providing for the risk element. That also is there. Right. See, capital has to be priced rightly. You cannot underprice it, you cannot overprice it. We have tried this nonsense of underpricing capital also. And I have dealt with this in, actually there is a wonderful interview by Biocon chief. And she says that we are underpricing. And in fact, it is easy to get investments in India. Say that online pharma will be a far easier way of funding, because there is no actual risks than a pharmacy which is manufacturing drugs. So by pricing it 11%, I think true manufacturers can come back and readily take the risk, and at 11% it may become sustainable.
Anyway, thank you, Mr. Venkatesh. Hope to see you next year.
Thank you, sir. Surely. It's a pleasure meeting you, sir.
Likewise. Thank you.
Thank you, sir. Thank you very much. I would like to, before we proceed with the vote of thanks, I would like to hand over the e-memento to the speakers. On behalf of the chamber, we would like to present this e-memento. This will be sent to the speakers by email. Yeah, next speaker, Madhu. Yeah, to Dr. M.R. Venkatesh. Thank you, sir. I would like to take this opportunity to thank the speakers for joining us amidst short notice. And I would like to thank the speakers for their excellent presentation and very precise, as well as the direct proposals are concerned, indirect taxes, as well as the economic overview of the central budget. I thank all the speakers for joining us. And I would like to thank Mr. Prasad, the chairman of Direct Taxes Subcommittee, and Mr. V.V. Sampath Kumar, the chairman of Indirect Taxes Subcommittee, for their excellent support in organizing this program. Thank you very much. And I would like to take this opportunity to thank all the executive committee members who have joined us today for this program. Thanks a lot, and we look forward to meet you in the next occasion. Thank you.
Thank you.
Thank you, Subbu. Thank you, MRV. Thank you, madam.
Thank you, sir.
Anand.
Anything else that you want to say, Sampath sir?
That's all. Thank you.
Thank you.
Thank you.